So a lot of operators talk about massive upsides of a deal, but most don't show you how they actually came to those numbers. And that's where investors can get burned. The problem is aggressive rent growth projections can make a deal look great on paper, but if they don't come true, returns suffer and investors get let down. So John and I, we're going to be breaking down in this episode how we forecast rent growth, what data we rely on, and the discipline that we use to avoid overpromising on our performas and our projections for investors. Because in today's environment, realism beats optimism every single time. Now, if you are thinking about investing into real estate, go to fulloutinvesting.com, find out a little bit more about our 10-step full out investing process. And there's a sample deal on there as well. And you can actually book a one-on-one call with myself to find out a little bit more if this is a good match for you. John, it's great to be here with you.
Good to be here, Mark. It's interesting, right? It's back to school time. I know every state's a little bit different down here in the US. I think Canada has probably got another month or so of summer. But my kids were back to school this week. So it's a little bittersweet. I always love having them home, but it's always also nice to get them back in the routine and with sports and just, not staying up too late. So how's everything going in your world?
Yeah, John, it reminds me, there was this one mom, it was about 5 years back. She would, every first day of school coming back after the summer holidays, she had three kids, and she would do this happy mom dance. It was just the funniest thing. The very first day, it was like, she's like, I'm doing my happy dance. I'm doing my
Yeah,
happy dance.
yeah,
And so it's interesting because I know she loved having the kids at home, but it was also like by the end of summer, she's like, okay, I'm good. I'm good. Like,
yeah,
you go back to school and let's get back into a regular routine type thing as well. So,
yeah,
on our end, it was a good summer. We had, it was busy, right? So the
yeah,
kids, they're busy doing their things, but they also, we'll say that they, had some good amount of time, relaxed time as well.
yeah.
And so it was a good kind of back and forth. But when they start school, it's like, you got soccer, you got football that's coming. And so it's kind of like the big deep breath before the storm, so to speak, when it comes down to a flurry of activity. So
Yeah, no, you're dead on with the storm. I mean, this is the first week of school. My daughter's she's a junior, but made varsity volleyball. They have a tournament this weekend. Soccer started up in full swing. So yeah, like it's just from kind of chill to like, boom, the storm almost overnight. But I love that stuff, man. There's nothing I love more than going to see my son play soccer or my daughter, play volleyball. My older son's in college and he's got a band, so we've been able to see him play some live shows around Atlanta. So it's a lot of fun now. That said, what's cool for him is he's really wanting. He told us his goal this year is to just take care of himself. So he's looking for a job in Athens, Georgia. And in the fall, his rent will not in the fall, actually in the spring, his rent will go to $600 a month. So his goal is to pay his own way. And I said, dude, don't put so much pressure on yourself. I still want you to get good grades, but he came to us with a plan, so I'm not going to get in
oh,
his
that's
way.
cool.
But yeah, he said, he wants to start figuring it out for himself. So yeah, we're really proud. But I think for my wife, what's happening is, one's in college, one's a junior, and she's starting to see this world that's going to exist in about 8 years where we're going to be empty nesters. And so if I'm not careful, or if I show her a picture of one of our kids when they're 2, she starts crying. They're getting old, So, but
Yeah.
it's that bittersweet I mentioned earlier, right? You love to see them grow, but it's also like one of these days they're not going to be here anymore. So anyway, it's a good time though.
Well, and it just goes to show you, I mean, it's so important that you're investing in the marriage along the way too,
Oh yeah,
because yeah, like that's the reality is the kids are going to be on their own and then it's just the two of you, right?
that's
And
right.
so that's one thing Joanna and I we've been very big on. It's like this is mommy and daddy date time. Like this is
Yeah,
important time. It's like we're going out and that's tough to do, like John, our investors are they're high net worth, but they're family as well, and
yeah,
they're also balancing it with business. And so that is one thing that we found along the way that they're busy, and so I'm sure the listeners can really appreciate where I'm coming from. It's like it's easy not to invest on that side of things as well when it comes to the family. And the reality is that time goes by fast and the kids grow up fast as well. My oldest is a grade 12. Like
yeah,
he's thinking about what he's going to be for university. And it's like,
yeah,
you got time is ticking. You got to make a decision. Do you want to not go to university? You want to go? And so I think he's settled on he is. And I'm like,
yeah.
that's where it's like guiding them in the right direction. It's like you want to guide, you don't want to like force, and you don't want to be too passive as well. So we're trying to figure out that kind of middle ground.
It's a real thing. Early on, a friend of ours, actually, because we had our first son at 22, book by a guy named Dr. John Roseman. And he's wrote a number of books, but the one we received, it said the number one thing, it was like the first lesson was to focus on the relationship with your spouse as almost the priority over the kids. Now, a lot of it was
Yeah.
talking about what you're talking about, but there's even just science to show that when the kids perceive that there's a strong bond between mother and father, they just feel more secure and more
Right.
calm and looked after, right? And so my wife and I are very similar with that. And in fact, I'd say she's my best friend. I'm very fortunate in that regard. We love spending time together, but we always have prioritized that, and it's worked well for us. But yeah, rent growth, like, shifting gears, I suppose. But
Going right from marriage into rent growth. They go so well together.
Yeah, that's right. But
Yeah.
it's a real thing, Mark. I mean, just you and I, we get deals sent to us all the time, right? I
Yeah.
mean,
Yeah,
we're
for
not
sure.
necessarily, I can't speak for you, but I know personally, I'm only actually investing in Faris Capital Partners deals today, and that's primarily driven by the fact that I have a level of control over these deals, right? And so I like that, right? I know that I can influence how they're performing, and so if I see something going wrong, I can do something about it. Where if I'm investing passively in another investment, so for me, I see some of these other deal decks and I sometimes question, like, where are they coming up with these numbers? They're a little like, blue sky, like, are they really being realistic here? And so, if you're listening to this and you're thinking of investing, do your due diligence on the operator, ask a lot of questions. Don't be afraid to dig into the details. But today we're going to talk about why rent growth is the number one driver of pro forma returns, and how we at Faris Capital Partners make sure that we're making not just predictions, but really, anticipating the future, right? So let's kind of start with a quick primer, right? At the end of the day, what we're trying to do is drive up net operating income. Now, net operating income in its simplest form is just income minus expenses. So we do try to drive down expenses where we can. That's renegotiating contracts. That might be working with our different vendors and our trades. For example, we're big on single sourcing vendors and trades. So for example, with our property management company, Asset Living, all of our assets are with them. And so what that means is instead of paying 3.5% of income for the property management fee, we were able to negotiate 2.5%. So it took us a while. We worked with many different property management companies, but we found one that kind of stood tall amongst the others and then formed a strong alliance with them. Now, we keep holding them accountable, and we're always pressuring them to consistently hit those results that we're looking for. But with trades, right, when you give a trade a number of projects, you can often negotiate better pricing. But the reality of tariffs and all these things that are happening, materials costs, supply chain issues, I can keep going, expenses are a little bit harder to control. So we really have to focus on that income component. And most of the upside in a value add deal comes from rental income, right? So that's where we really focus a lot of tension, and small changes in those projected rent growth can create large swings in, potential the returns, right? And that equity multiple. So it's the first thing you need to focus on, and you need to put a lot of focus, time, and attention on. So we're going to get into our framework for forecasting rent growth. But Mark, any thoughts before we dive further in?
Yeah, so really there's like three big, we'll call them levers when we're looking at our pro forma, and it's interesting. Like rent growth is definitely that's right at the top of the list. The other one are exit cap rates, which we'll do another episode on that as well in regards to projecting future cap rates, as in like what's the multiple or the what we'll call it the variable that we're going to actually factor in what the exit sale price is. And we're going to be talking about that and how we come up with that. But the other ones are your projected rents and if you can hit those or not. So that's something that we prove out the last four assets, John, that we've been proving it, what we project, we've been hitting and actually surpassing. But, the future cap rates, that's something that's, pretty straightforward, which we'll do another episode. But the rent growth, that's like, if you move at 0.25% rent growth one way or another, it actually impacts the numbers. It's a big lift versus we'll just say, oh, we're not going to spend $50,000 on doing this renovation. Let's see what that does. Like, it's a very little bump when it comes down to doing it that way. So, but with rental increases and what that is, being very modest and conservative with that is, it can impact the numbers if you're overzealous, so to speak. So that's definitely, it's a really important one to look at. And then what are the operators, what are they factoring in to be conservative of what rental increases are? Because there's no guarantees that it's going to go one way or another. And if you say like it's going to go up by 10% every year, and of course it's going to go up 10%, the reality is that your returns can be impacted drastically if you're being, you're not being conservative with those numbers.
That's right. So, how do we arrive at these conservative numbers? Well, the first thing we do, because this is where we're sort of, maybe we have a deal that's been sent to us and we're doing an initial underwriting. So, we want to get in and start looking at rents. But we have not yet seen the property, right? So, first thing we do is we, don't rely on what the broker tells us. Now, it's not to say the broker is giving us bad information, but at the end of the day, the broker works for the seller. And so they're going to do their best to put the property in the best possible light. And one of the things we've seen more recently, because a lot of operators bought their deals at the peak of the market, say in 2018, 19, and 20, they're trying to get to a number. And so sometimes those numbers that we get from the broker might be massaged a little bit, right? Where maybe a rent comp they pull is like 2 or 3 miles away. And so at first glance, you might say, well, that's pretty close. But it actually crosses a line into a different county where maybe the schools are a little bit different, or maybe even just a different city. Or there's some economic factor. Like, there was one deal we were looking at in Atlanta that stands up to me where, it was a few miles from Brookhaven, which is like a hot up and coming area. It's a neighborhood just next to Buckhead, one of the premier areas of Atlanta. But this pocket, Doraville, has a lot of industrial. And so some of the comps we saw were from Brookhaven, and it's just like not the same thing, right? And so you just have to really slow down. So what we do is we leverage websites like CoStar.com. Now, most brokers are inputting data into CoStar. CoStar actually is owned, the parent company of CoStar owns Apartments.com, which is kind of like the Zillow, if you will, for apartments. So they also own some property managed software behind the scenes. So the data that's feeding in there is actually real world asking rents. So we go first and foremost, we start looking at what are the comps in the immediate area, the 1 mile, 3 mile, 5 mile radius. And then we look for similar vintage, similar asset class, similar unit size. So you have to get really granular here. And then we go all the way into, kind of like making sure, are these aspirational numbers, right? So one of the things we add on top of that is our property management company will actually secret shop these comps. So they'll call and almost pretend to be a potential resident and ask what the asking rents are. Because what you'll sometimes find is if you go to their website, they'll say, oh, it's $1,600 a month. But then come to find out they're giving $400 off the first 2 months rent, or they're giving, 1 month free or something. And so the effective rent is actually much lower. So, it's really an important extra step to actually call these comps and actually learn what's really going on here. Is what they're advertising on their site the reality of what they're actually signing? Because those can be two different things. So that's kind of where we start. Now, once we have that information and it's looking like a deal we'd like to pursue, then we do our tour. But after we tour the asset, the next step is touring those comps in person, Mark. So I know that's something you and I have a lot of fun with. But yeah, tell me your perspective
Yeah.
on those rent comps.
Yeah, the rent comps are really important because what you see on paper is not always what you see in reality. And so this is something that we're really big on, actually walking through the comparable apartment communities to actually verify, are our rent projections, are they real or not? Because I mean, listen, like, what you see on the internet, I mean, there is not always the reality. And so when we're making these decisions, we're buying these buildings, 20, $30 million buildings. The reality is we need to actually go boots on the ground and actually compare what the other communities are actually getting. And our projections have we verified them or not? Because I mean, listen, you go and say you do your online research and then you just don't hit them. And as an investor, you ask the operator and say, hey, listen, did you actually go and walk these comparable properties? And you say, no. I mean, that's not a professional. that's not a professional response, right? Of course you need to go in person. And so this is something that we do. And when we go through, we don't lie to them and say, "Hey, listen, I'm a tenant." We tell
Right.
them. We say up front, it's like, "Listen, we're doing market research. And what can you tell us about the community? And what are you charging for rents? And tell us a little bit about your occupancy. And listen, there are some times that we get blown off. Okay, and so we do as much research as we can, and we as much data collection as we can. But we still ask the questions every time, and sometimes it's uncomfortable. It's like you walk up there and it's like, well, I'm busy right now. I don't. You're going to need to come back, right? And so you go through, but the key there is you want to walk through the community and actually get a sense, is your community actually at that level? Is it inferior or is it superior to that comparable? And it's the same thing that we did, John, and do on the residential side. You want to be able to, ideally, if you're pricing a property, you always will have an advantage if you walk through the comparable sales that have actually happened. And the comparable sales, when it comes to the multifamily space, they're available to go walk through many times, and you can actually go do that research. So that, I think, is if critically important to your overall thesis, so that at the end of the day, whatever your projections are, you're going to hit or exceed, and you feel very confident. And it's not a maybe, because then you need to start reporting those projected rents of what you're getting to your investors. And the last thing that you need within a few months of closing is to say, hey, listen, we're not hitting our projected rents. The market is
That's right.
not dictating that. Then you have mud on your face, right? So you want to make sure that you do everything that you can from a due diligence standpoint to verify your rents and not take any risks by guessing.
And one of the secondary benefits that I actually love as well when you're touring these rent comps, because we're looking at the amenities, the vibe, sort of like what's going on in the community. We often get good ideas, right? I mean, there's been time where it's simply just like a flyer, like, and you're like, wow, that's a neat little marketing piece. Like, we should have something like that at our assets. Or maybe it's something they've done to the amenities at the pool where, we were touring one and they actually had these almost like cabana style setups. And we're like, wow, that might be something neat we could implement. Or when you're walking through units, we're talking with the leasing manager and asking them, like, what units are moving faster? Like, what are some of your residents looking for? Or what are some of their pain points? So we get a lot of intelligence even beyond the rent comps, up to including really great ideas that we can implement, or maybe some things that we should avoid, right? Things that aren't working. For example, me walk through and say, yeah, we implemented this tech package program, but residents don't really like it, or we charge an amenities fee and people are upset about it, right? So we look for a different approach where we can still drive up that NOI, but not do something that might be detrimental to our ability to convert prospects into residents. So it's just all about looking for those comparable. You said it. Are we inferior? Are we superior? And I'll use a property that we were pretty close on. You remember that deal in Smyrna, Georgia, which is right near Truist Park where the Braves play. We really liked the deal. There were really two factors. One, we discovered some retaining walls that we thought had been replaced that hadn't been. But the bigger factor in my mind was, remember, so just so you think about it, right? We're mapping out all these, rent comps to tour. And so I use a route optimizer. So we start at the deal and then we kind of optimize them. And then we sort of end up back at the deal. So that last comp we toured on that deal, remember, it was just like a half mile down the street. And we walked through and we're like, these units are bigger. The floor plans are more functional, and they're actually getting rent where we're targeting, and we'll never be able to compete with this. They're going to beat us
Yeah.
every single time. And so
Yeah.
because of those two factors, we actually had to withdraw our LOI, which is not something we were super happy about, but we found some things that just told us that it wasn't the right deal for us. So we walked away. So it is such a critical component. So it goes back to, if you're not investing with us, if you're investing with another operator, ask that question: did you personally tour these rent comps, and how confident are you in your ability to hit these projected rents? It'll tell you a lot if they tell you they did not take the time to do it. As I shared with you earlier, Mark, like, I love doing it. It's actually fun. It's nice looking at competitors, getting ideas, seeing what's going on, and it's a critical part of the process for sure.
Yeah, right on. So next, we're looking at the actual leasing data, John. I know that's something that is like the best way to verify if a renovated unit is going to get a certain rent is to actually look at today, is a renovated unit in the lease, when you're doing the lease audits, are they getting the higher projected rents? And in some cases, John, it's like we see that the existing operator has renovated some rents, and in those renovated units, they're actually already getting what we're projecting to get. They just haven't made it through a good portion of that. So that is like one of the best ways to verify rents is, are they currently getting those higher rents today?
That's right. Yeah, I mean, I really what comes to mind is Faris Residences Noonan. We're actually almost complete with that raise right now. I mean, we're only I'd say probably three-quarters of the way through it. But the current operator had renovated 16 units, and they're getting the rents, right? So we're just saying we're going to continue down that path. We're not saying we're going to get $50 or $100 more. It's like they're getting that $340 rent lift. We know, because by the way, we do a better job. Not that they've done a terrible job, but I would say they did about 90% of what we would do. We just put that extra 10% in. So backsplash, the glass top, electric ovens, things of that nature, just a little bit of extra sizzle that would really help us ensure by not spending a lot of extra money. But we kept the rent projections the same. So, we're actually pretty confident we'll probably surpass them a little bit, but our underwriting still shows that number that we know was already achievable. And then we have to really get back into the data a little bit, looking at the submarket reports and looking at what inventory is coming online and how that might impact our ability to continue those rents, 3, 4, 5 years potentially into the future. So it's not something that's one and done throughout the process. From even right before we submit our LOI, we're constantly going back to that model and making tweaks and adjustments just to make sure that with confidence we can hit those numbers.
Right on. Next is we're looking at affordability. So this is a really big one. As you know, John, we want to make sure that we're staying at least below 35% income to rent ratio. So once we do our renovations, we need to look at what is the average and median income in an area and in a community to verify, hey, listen, are the projected rents, will this area support and will this neighborhood support those higher rents? Because like, for example, Toronto, for example, the average income to rent ratio is like 60%. In New York, it's 70%. So the reality is that if you are projecting rental increases in your pro forma and you're already charging like 50, 60, 70% of the average income, that means that you're going to need to draw from people that are commuting into the city, and that's going to be coming in, and you're going to really lower the amount of potential residents that can actually afford to buy in that belt or to rent in that community. So this is something that's really important, that when we buy in an area, it's got to be under 35% and ideally under 30% of the income to rent ratio to make sure that the largest portion of potential residents can actually afford it and afford the rent increases as well.
That's right. And then really the final step, and we've already talked to our property management team, as I mentioned earlier in the process, but we have them do a final check when we've locked our model, right? We feel very confident in these numbers. We're about to submit our LOIs. So we cross check with our property manager, just because at the end of the day, they're managing the property. So they have to be confident that they can hit these numbers, right? And so they're going to come back and give us any feedback they might have. And then lenders often apply their own rent growth caps as well, right? Because lenders have a treasure trove of data. So, they're assessing risk on the particular deal. So they'll give us feedback if they think we're too aggressive, or maybe there's an opportunity to maybe push a little bit more. But really, at the end of the day, it comes down to that final check. And that's, would we put our own money into the deal? And since we put money into every single one of our deals, if that answer is not yes, we have to pause and take a step back and maybe not pursue that particular asset.
Yeah, right on. And so if you're looking at a deal and they're projecting like 10% rent growth, this is something that is concerning. For us, we look at CoStar as really a good base as to what are projected increases when it comes to rents. And so that's not just a guess. So CoStar has hundreds and hundreds of analysts. I think even that, how many analysts does CoStar have, John?
From what I understand, at least 1,000.
Yeah.
Yeah. I mean, yeah, it's a massive, massive team of data scientists and data collectors over there.
So they track the number of new deliveries coming to a market and population, and then they have their formulas to be able to project what are going to be rental increases. And so for us, we look at what that is, and generally what we do is we actually say, okay, listen, we need to be a little bit more conservative than what the projections are. And so generally that lands somewhere in that kind of 3 to 3.5% is where we like to be. But we are definitely more conservative of what the rental increases are. But 3 to 3.5% on average, if it's gone up 5%, the reality is that we're very conservative when it comes to that. And really that helps to keep it in line with inflation. So just by keeping it in line with inflation, it's a very conservative approach versus, if you're in an area with zero inflation, well, then you're hoping it's going to go up. But with inflation, it's more of a conservative number in that kind of 3 to 3.5% rental growth.
That's right. And just one final point, that we're talking about the rental income coming in, but you also have to be mindful that there will be a certain amount of vacancies, right? That just there's seasonality sometimes. Like, for example, in Charleston, there is a big wind down. November and December aren't big leasing months. So we're always looking far ahead once we own the asset. But in the underwriting, we have to take into account a certain amount of vacancy as well as bad debt. Now, bad debt in the context of multifamily real estate is somebody who has not paid their rent, right? So, we underwrite our residents very conservatively. We do background checks, a criminal, credit. We look to make sure they've had no other evictions in the past. We try to check all these boxes, but inevitably, things happen. Somebody loses their job, whatever the circumstances are. So you have to make sure that you're also underwriting a healthy and a realistic amount of bad debt and vacancy into your projections. So just once again, as a listener to this and you're thinking of investing, ask about those and make sure that the operator is factoring in those things that will happen at the end of the day. You can't avoid it. It's inevitable. Somebody will not pay the rent at some point in your deal. And so making sure that's budgeted in.
Yeah, 100%. So as a recap here, if you overstate what your rental projections are, then you're going to have, as an operator, you're going to have broken trust when it comes down to the investors of, that you're not matching up what you said you were going to do. So being conservative on those projections, it leads to less oops and more of, oh, great job, you are executing on what you say you're going to do. Because oops on these deals, it just can't happen because you're dealing with millions and millions of dollars. So there's a seriousness to what those are. And listen, these are 3 to 5 year holds as well. So if you're constantly falling short for 3 to 5 years, that's not a very enjoyable ride. You want to make sure to over deliver. It is a much more enjoyable ride for everybody, and it builds more trust with your investors as well. So, especially in today's market where there's a lot of uncertainty, under promising, over delivery is the key to really great service. So, rent growth can't be guessed. It's got to be supported with data, looking at the comps, actually physically walking through, and then the affordability side of it as well. And underwriting is a very big part to make sure that you are going to deliver on those at the end of the day. So being conservative is just never a bad plan to be conservative at the end of the day. John, anything else on your side?
No, I think you covered it, Mark. Just that reminder, fulloutinvesting.com, great resource. Please take a look. Sample deal. We walk you through our 10-step process for investing success in multifamily buildings. And you can book a time to talk with Mark to go through your investment goals, ask us any questions, and to learn more.
Right on. Well, thanks for listening, everyone. If you enjoyed the show, please share and subscribe to the channel and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.